ESG factors can materially influence security valuation across multiple asset classes because they affect risk, return, cash flow generation, capital allocation, regulatory exposure, and long-term sustainability. Investors increasingly recognize that environmental, social, and governance issues can alter financial performance and therefore influence intrinsic value. ESG analysis complements traditional valuation methods by identifying risks and opportunities that may not be fully reflected in historical financial statements or market prices. The impact of ESG factors varies by asset class because ownership rights, investment horizons, contractual relationships, and valuation methodologies differ. Consequently, investors integrate ESG considerations into valuation frameworks to improve risk assessment and enhance long-term investment decision-making. In public equities, ESG factors can affect valuation through their influence on revenues, operating costs, growth prospects, capital expenditures, and discount rates. Strong environmental performance may improve resource efficiency and reduce regulatory risks, while effective social practices can strengthen employee productivity and customer loyalty. Robust governance often supports better capital allocation and strategic decision-making. Analysts may incorporate ESG factors by adjusting forecast assumptions within discounted cash flow models or by modifying valuation multiples to reflect differences in risk and growth expectations. Companies with strong ESG profiles may command valuation premiums, while those exposed to significant ESG risks may experience lower valuations and higher required returns. For corporate fixed income securities, ESG factors primarily influence valuation through their effect on credit quality and default risk. Environmental liabilities, social controversies, governance failures, and regulatory penalties can weaken an issuer's financial position and impair its ability to meet debt obligations. Investors therefore assess ESG risks alongside traditional credit metrics when evaluating corporate bonds. Companies with effective ESG management may demonstrate stronger financial resilience and lower credit risk, resulting in tighter credit spreads and lower borrowing costs. Conversely, significant ESG weaknesses may increase uncertainty, widen spreads, reduce bond prices, and negatively affect overall creditworthiness and valuation. In sovereign debt markets, ESG considerations influence assessments of economic stability, fiscal sustainability, institutional quality, and long-term development prospects. Environmental risks such as climate vulnerability, social issues including inequality and demographic pressures, and governance factors such as corruption, rule of law, and regulatory effectiveness can affect a country's economic performance and repayment capacity. Investors increasingly incorporate ESG analysis into sovereign credit assessments because these factors may influence government revenues, expenditures, political stability, and debt sustainability. Strong ESG characteristics may support lower borrowing costs and stronger credit profiles, while weak ESG conditions can increase sovereign risk and negatively affect bond valuations. ESG factors also play an important role in private markets, real estate, infrastructure, and alternative investments. In private equity, ESG performance can influence operational improvements, exit valuations, and long-term growth opportunities. Real estate valuations may be affected by energy efficiency, climate resilience, tenant well-being, and regulatory compliance. Infrastructure assets are particularly sensitive to environmental regulations, stakeholder relationships, governance structures, and long-term sustainability trends. Investors often integrate ESG considerations into due diligence processes, cash flow projections, and risk assessments. Because these assets frequently involve long investment horizons, ESG factors can have substantial effects on valuation outcomes and long-term investment performance. Across all asset classes, ESG factors affect valuation by influencing both expected cash flows and perceived risk. Environmental risks may increase operating costs or require capital investment. Social factors can affect stakeholder relationships and productivity, and governance quality influences strategic execution and accountability. Investors may incorporate ESG considerations through scenario analysis, risk premiums, forecast adjustments, credit assessments, or qualitative valuation judgments. As ESG issues become increasingly material to financial performance, valuation frameworks continue to evolve to capture their economic impact more effectively. Integrating ESG analysis across asset classes enables investors to develop a more comprehensive understanding of risk, opportunity, and long-term value creation potential within diversified investment portfolios.